Hello, this is a brief history of the American stock markets by me, Garrett Smith. The first stock exchange was the Amsterdam Stock Exchange. It was founded in the late 17th century by the Dutch East India Trading Company. From there, the Dutch East India Trading Company would sell its shares to investors. The reason for this was that the company wanted to fund voyages to other countries to trade spices and other goods. Along with this, the company proprietors felt it was necessary to reduce their risk in case a vessel were to be lost to bad weather or pirates. This was the first initial public offering in the world. Almost 2 centuries later, the United States government felt it was necessary to refinance their debt, so they issued war bonds, which were a term of loan that they would sell to investors. Another pivotal moment in this time was in 1792, where 24 signees of the Bretton Woods Agreement agreed to sell their shares of loans and stocks and bonds at a commission. 20 years later, the New York Stock and Exchange Board was founded by these signees, and from there, stock markets took off. This wasn't the first American stock market, however, that was the Philadelphia Stock Exchange, which was created in 1790. During the 1800s, Samuel Morse created not the stock ticker, but the telegraph. Edward Callahan created the stock ticker. The stock ticker produced minute-by-minute prices of stocks in New York and Philadelphia, and this became a very pivotal moment in the history of the stock markets because it became near instant information of the prices of stocks that investors wanted to buy. 80 years later, in the 1920s, the markets were experiencing very high returns and everybody wanted to get their hand in the cookie jar. Brokers felt that it was a good idea to actually issue loans to investors to help them produce more money, and this was called margin. This was actually one of the factors that contributed to how badly the stock market crashed in the late 1920s. In the late 1920s, the stock exchange starts to experience a free fall, and investors felt it was necessary to pull out their money. However, a lot of people pulled out their money, and this led to the crash. Because of this, lawmakers felt it was necessary to actually regulate the stock exchange because they felt that the free market was much too free and that managed capitalism would actually be a better alternative. They created the Stock and Exchange Commission, which was created from the Stock and Exchange Securities Act in the early 1930s. Today in modern markets, we trade at a very, very high rate. I think the last time it was recorded, it was around 11 billion trades. And we are actually seeing what is called high frequency trading, where computers and algorithms actually trade for us by reading financials and news reports to actually make those trades. This has actually caused what are called flash crashes, where computers will sell off high amounts of stocks at a very, very quick moment and then buy them back again, which has actually caused some markets to do what is called capitulation, where they will actually shut down the markets to prevent this from happening. Another thing is that these high frequency trades are performed by very large banks, and you can actually see them outside of the New York Stock Exchange, where they run very large cables and trade at very high volumes through computers that are known as black boxes, which we will never see because they keep them very well locked up. Some stock tidbits. There are many markets around the world. There's the Tokyo market. There's also the Shanghai stock market, if I'm not mistaken. And there's still the Amsterdam Stock Exchange, but it is merged with the European stock market, which is the Euronext Exchange. There is also the Brussels Exchange. This is it for my presentation, and I hope you have a good day.